everybody. It is 3 o'clock Mauritius time, so we will get started. I am Caoilfhionn van der Walt. I'm the managing partner of Regan van Rooy, and we have with us today Heemshika Haguthee from our Mauritian tax team. And our plan is to give you a short, sharp, sweet synopsis of all that happened in last week's budget speech. So the plan for today is that I'll start with some initial kind of thoughts and comments and key takeaways, and then Heemshika will take us through the main elements of the budget, going through the personal tax changes, the corporate tax changes, the VAT tax changes, immigration changes, property changes, and tax administration. And then we do have some time at the end for questions. I'll be monitoring the chat as we go, so please feel free to put any comments or questions in the chat, and we'll deal with them at the end. So let's get started. In terms of the key takeaways from the budget, so obviously this was the first budget of the new government, and we saw in South Africa how things can often go wrong with a first budget of a new government. Luckily, nothing like that happened here, so it was very smooth, I think quite well thought through. My general feel on the budget is it wasn't as bad as I feared. There was a lot of concern it would be an austerity budget, given where we are in Mauritius in terms of the national debt and the general economic position. I think there were definitely some some harsh news, but overall it's not as bad as I feared. Our key takeaway is that if you're a foreigner living in Mauritius, you're more and more treated like a foreigner. And so there have been some quite punitive measures brought in for non-citizens. So we'll go through them now. Firstly, various of the permits, the term have reduced from 10 to 5 years. So in particular, the retirement permit and the investment permit, which is quite unfortunate, and I think does give foreigners living here a bit more uncertainty. Also in 2023, there was a great new scheme announced whereby foreigners, non-citizens, were allowed to buy property in Mauritius, anywhere in Mauritius, at an elevated price, but you could still buy the property. That has now been discontinued, which again shows the protectionist view of, kind of anti-non-citizens owning property. There's also been restrictions in terms of the types of apartment that foreigners can buy. And I think worst of all, we're seeing a capital gains tax. So Mauritius has always said it doesn't levy capital gains tax, and now we're seeing that on the disposal of property by non-citizens. They're not calling it a capital gains tax, it's being called a land transfer tax. But essentially, going forward, whenever a non-citizen living in Mauritius disposes of his or her property, they'll be subject to a tax of either 30% of the profit or 10% of the value, whichever is higher. And this is a big deal, and I think is quite unfair because it doesn't differentiate between a non-citizen who's a non-resident and a non-citizen who is a resident. So you can get people like me who've been living in Mauritius for 7 years, whose kids go to local school, who employ Mauritian people, but still if I buy a property here and what I can buy is now restricted, I will be subject to capital gains tax on the sale, despite every country in the world having an exemption on capital gains tax on the sale of someone's personal property. So I think this is very bad news and is creating a lot of negativity in the expat market in Mauritius. Also, the transfer tax, so when you buy property, has increased by 100%, so from 5% to 10%, which is going to be a big impact on property buyers in Mauritius. In terms of personal tax, the big change is the introduction of what they call the fair share contribution, which is an additional 15% for individuals who earn more than 12 million rupees. Now, 12 million rupees is a lot of money. It's like $270,000 US, but that means that anyone who earns over that is subject to a top tax rate of 35%, which is unheard of for Mauritius, who's always been selling itself as a low, stable tax economy. And I think this is unfortunate because generally people who earn that type of salary are very mobile, so they can easily restructure their earnings or their assets, or indeed emigrate from the country. And so I do think we're going to see some movement from people who could be adversely impacted by this. But it really is quite a shock that you've got a 35% headline rate for certain earners. And the net income does include local dividends. So the FSC is essentially the solidarity levy under a different name, although the solidarity levy obviously kicked in at a much lower level. We're also seeing the FSC for companies. So GBLs are excluded. And I think that's going to be interesting in terms of Mauritius trying to justify how it can exclude global businesses from a tax in terms of the OECD, BEPS initiatives in terms of not having exclusionary exemptions. But we'll see how they do. So the new FSC will apply at a rate of 5% for domestic companies. So we know that domestic companies have a headline tax rate of 15%, but then there's a sneaky CSR of 2%. Corporate social responsibility levy, and another new 2% of the climate change levy. And now there's going to be another 5%. So it means that domestic companies will now be taxed at 24%, which is extremely high when you think that the current tax rate in the UK, for instance, is 23%. Also, export companies, so GBLs that export goods, they've had a beneficial 3% regime, and gradually that's been increased with the 2% climate change levy, and now there's an extra 2% in terms of the FSC. So that is going to increase those rates. It's only applying where taxable income is over 24 million rupees, but this is going to have a significant tax increase on many, many companies. We're also seeing, which is very interesting, Mauritius now saying it's bringing in this QD to basically stop people using tax havens. So Mauritius announced in 2022 that it would be bringing in a top-up tax. And essentially, it means that if a Mauritian company is part of a group and the overall group revenues are more than 750 million euros, that if any of the underlying subsidiaries are suffering less than 15% tax, then Mauritius can top it up by charging more tax. So we won't see exactly how the rules will work probably until the finance bill comes out next month, but I see this as quite a seismic shift. We saw that Dubai recently brought in a Pillar 2 tax as well. So I think Mauritius is following their lead, but it links to the next point, which is that the minister announced that rules will come out to clarify the arm's length principle. So transfer pricing is going to become a real issue for all Mauritian businesses, I think, and we'll have to see again what those rules say. But clearly, transfer pricing, which is linked to the Pillar 2 top-up tax, is going to become a bigger deal for all multinationals who are operating from Mauritius. There's also another nasty little tax called the alternative minimum tax. Now, this is an interesting one. It applies to certain types of businesses, and it looks at their accounting profits. So we've known, the kind of tax 101 is that tax profit is not the same as accounting profit, but the government is now looking at accounting profit and saying, if your tax is less than 10% of your accounting profit, then you need to pay more tax and you need to pay an additional 10%. This will apply only to certain types of businesses, which Heemshika will go through later, but this is going to have a very significant impact on a lot of companies in Mauritius. And last but not least, this is a small one, charitable deductions. It used to be that individuals could deduct against their tax in their tax calc whatever they donated to charity. They're no longer able to, which is bad news. But now companies can allocate 50% of their CSR allocation to a charity of their choice rather than 25% as previous. So that's what we see as the main relevant changes for our shareholders. And my kind of key takeaway is not as bad as it could be, but I think that there is a real concern that Mauritius is losing its cachet to foreigners who want to look, who are globally mobile, who are very savvy in terms of choosing a jurisdiction to operate from. And I think we are going to see a decrease in uptake of businesses and individuals owning businesses moving to Mauritius. So Sia, I'll hand over to you now to take us through the detail.
Thank you, Caoilfhionn. So we'll move on to the first one, which is personal tax. With a simplification of the tax bracket from currently 11 bands, it will now be 3 bands. As we can see, in this table, that the first 500,000 rupees are exempt, which actually removes around 44,000 people completely from the income tax net. But the rate increases to 10% for the next 500,000 rupees and 20% for above 1 million rupees. But not all people are the hardest to hit. Unlike the previous, the Solidarity Levy, as Caoilfhionn previously mentioned, which was abolished in 2023, as now only high-income earners will have to pay more taxes as per the fair contribution, where an additional 15% on the chargeable income that exceeds 12 million rupees, which will also include dividends, which is kind of around 268,000 USD or 234,000 euros. Meaning that these individuals, which is less than 1,000 population in Mauritius, will pay the progressive tax rate of 10% and 20% plus the additional 15%, which brings the effective tax rate to 35%. And this will be applicable as from the 1st of July for 3 consecutive income years, and it will be collected under the PYE system. With the Contribution Sociale Généralisée, the monthly CSG income allowance, this will gradually decrease for individuals who receive a monthly income between 20K to 50K until the end of June 2027, and it will then be stopped. The intention is to scrap over the CSG and then replace it by the previous National Saving Funds, which was previously implemented by the government. Moving on to some reliefs that will be renewed and eventually phase out over 2 years, and this will include the following: the CSG income allowance, CSG child allowance, maternity allowance, house loan relief, with also the complete phase out of home loan payment scheme, wages paid to household employees, donation to charitable institution. This will be removed by the end of this year, by June of this year. This will surely decrease the disposable income for those people who were claiming these allowances and reliefs in the personal tax, as now they will have a higher tax burden. But one good news is for our youth, age 18 to 28, for both resident and non-resident, who will be tax exempt on their annual emoluments or business income of up to 1 million rupees. Now let's take a look on the corporate side. With the intention of the fair share contribution for companies whose annual chargeable income exceeds 24 million rupees, will now have an additional 5% if their standard corporate tax is 15%. That is, domestic companies' effective tax rate will be 24%. This will include the corporate income tax of 15%, with now the additional 5% fair share contribution, the 2% CSR fund, and the last year's introduction of the CCR levy of 2%. While an additional 5% for banks, including income from non-resident and GBL companies, and a 2% for companies with preferential 3% tax rate, which includes export companies. That brings the effective tax to 9%. However, for foreign taxes would not be able to be used to offset the fair share contribution. And the fair share contribution will be required for a quarterly payment, similar to the advanced payment system in Mauritius. The next tax implementation is the new introduction of the alternative minimum tax at the rate of 10% of adjusted book profit for companies operating in sectors like hotels, insurance companies, real estate, telecommunication, and financial intermediation activities. Meaning that for those companies with significant accounting profit, but little to no taxable income, will be required to pay a minimum tax equal to 10% of their accounting profit. It is important to note that the alternative minimum tax, as well as the fair share contribution, will not be applicable to global business license company, exempt bodies, and companies benefiting from tax holidays. The next one is the domestic minimum top-up tax, which was announced in 2022, but now the government confirmed that this will be applicable as from the 1st of July 2025 in order to comply with the OECD. But with a minimum tax of 15%, this will be applicable for foreign subsidiaries of multinational enterprises based in Mauritius, whose annual consolidated revenue is 750 million euros or more, and is being taxed at an effective rate of less than 15% in other jurisdictions. So with these new taxes, the government has also introduced some exemptions, such as investment tax credit of 5% over 3 years for small businesses whose annual turnover does not exceed 10 million rupees, on their cost of acquisition of new equipment of up to 500,000 rupees. But this will exclude motor vehicles. As there is a new addition to the eligibility of the 80% partial exemption, this will be beneficial for companies who hold virtual asset license. And also, a company can now spend 50% of its CSR fund, which was previously just 25%. Last but not the least, any company whose foreign currency turnover exceeds 50% must settle its tax liabilities in that same currency, which will improve Mauritius' foreign exchange position. Now we'll take a look at the small medium enterprises in Mauritius, whose annual turnover are less than 100 million rupees. They will have an exclusive deduction such as the 200% on expenses related to establishment of creche or for patents, or a 300 deduction on donation to eligible charitable institution, but this is capped with 1 million rupees, as well as a tax deduction of up to 150,000 rupees in AI investment. Now, on to the value-added tax. So as from the 1st of October of this year, the VAT registration threshold has changed from 6 million to now 3 million rupees, making more small businesses liable to register. So now we'll have to prepare ourselves to see an increase in food items like the diaper prices being maybe 30 rupees. Also, the turnover threshold for compulsory registration for invoicing has decreased from 100 million to now 80 million. And items like canned vegetables or frozen packet vegetables and hairdressing services will now be zero-rated items. Effective as from the 1st of January of next year, the VAT on digital or electric services by foreign suppliers will be implemented, which means that, in theory, we will now have to pay VAT on our Netflix subscriptions. This point was previously not clear, but now it is clear and will be amended in the VAT Act of Mauritius that services provided to a foreigner who is physically outside of Mauritius at the time of the supply will still be subject to a 15% VAT rate if the services is consumed in Mauritius. Overall, we have not seen an increase in the VAT rate, but with these measures, the government is getting majority of its revenue from VAT, which is around 26 billion rupees over the next 3 years. Let's take a look now at our expats. Introduction of 2 different categories of occupations permits for non-citizens professionals with a view to targeting highly qualified professionals, and another category are for investors with criteria based on initial investment and specified turnover. And the eligibility criteria for the residence permit will also be reviewed this year. The validity period for retired non-citizens residence permit, as well as the occupation permit for investors and self-employed individuals, will be reduced from 10 years to 5 years now, with the option of renewal subject to compliance. And a maximum age limit of 24 years instead of previously 18 years will now apply to dependent children across all permits categories in Mauritius. Retired non-citizens holding residence permits must now reside in Mauritius for at least 180 days per year so that they can retain their permits. And individuals holding a retired non-citizen's residence permit will be prohibited from taking up employment or conducting any business activities in Mauritius. And the next slide is on property tax. The scheme introduced in 2023, which allows non-citizens to acquire residential properties, including their land, anywhere in Mauritius, provided the property price exceeds 500,000 USD, will now be discontinued. And non-citizens or a person not resident in Mauritius will be prohibited to the disposal or acquisition of an apartment in a building of at least 2 floors above ground floor, which has been constructed on state land. Moving on is non-citizens purchasing residential property under the EDB approved schemes will now pay a 10% registration duty. Previously, it was 5% on the property value at the time of the registration. Land transfer tax payable by non-citizens on resales of properties will be the higher of 10% of the property value or a 30% of capital gains. That is the resale value less the purchase price. And at the time of the registration of the date of sale, the land transfer tax will be 10% instead of previously 5% tax rates. The new rate for land transfer tax and registration duty in respect will start to be applicable as from the date of the publication of the Finance Act. And the Finance Act is usually published before the end of July. So we'll have to wait for the Finance Act to be released to get more clarity on the registration date. The last slide is the tax administration. The period for MOA to raise an assessment has been shortened from 3 years to 2-year period, where prior to the current year of assessment. And taxpayers who have underdeclared or failed to declare income or taxable supplies will be eligible for 100% waiver of penalties and interest, provided they voluntarily disclose the underdeclared amount to the MRA. And the arm's length principle was previously not very clear to us. So now the scope and methodology will be reviewed to provide greater clarity to taxpayers. Thank you. Now we are open for some questions if there's in the chat.
Good timing, Sia. We've got 5 minutes left. We wanted to make sure we had a nice short presentation. Guys, any more questions? I think we're seeing some comments about how it's not great for non-citizen and expats. Totally agree. Contrary to the spirit of the EDB roadshows, totally agree. Some questions, Sia, around the financial intermediaries. That wouldn't include a treasury company, is my understanding. It's more for insurance companies and peer-to-peer lending and those types of things.
Yes, but I will look at the annex again, and if it does include, then we'll email you and let you know about it.
Cool. And the requirement of paying tax in Forex, if you earn more than 50% of your profits in foreign currency, is a requirement, is it? It's not optional.
Yeah, it has been said a requirement.
Yeah. Then I think we have answered all of the questions in the chat. Any other questions or comments? Okay, well, thank you, Sia, for that nice summary. We will send the presentation and so the slides and a recording of this out to everyone who's registered. And if you have any questions, Heemshika and my emails are on the last slide. But otherwise, thank you very much for attending today. We hope you found it useful. Okay, one more question. Are the tax changes already in force from 1 July? So some of them are. And some of them will be in force when some of them have a specific date, like I know 1 January or some of the 1 January next year, some of the changes. A lot of them are 1 July, particularly the FSC, which the fair share contribution, which is quite unfair, given that it means we'll be taxed on profits that accrued before the change came in. And some of the changes are from the date the finance bill will be published. And that's specifically the land transfer tax. Anything I've missed, Sia?
No, you've covered it.
Great. So if we have no more questions, we will log off there. Oh no, we have one more. Please confirm whether the corporate tax rate for GBL companies have essentially remained the same. Yes, they have, unless it's a GBL company that has the export 3% regime, but otherwise, yes. And that's what I was saying about how we'll have to, in general, the OECD tries to shut down any exemptions that are ring-fenced to a specific sector of the economy. That's why Ireland, my old stomping ground, had to change the tax benefits it had only for foreign companies. And now the way a lot of the changes are in Mauritius, there's lower tax for GBLs, which are generally companies trading externally. So I do think there is a risk that that will be found to be in contravention of the OECD BEPS initiative. But so far, you're right, GBLs will essentially remain the same. It's individuals, domestic companies, banks in particular, and export companies that are going to bear the brunt of the higher taxes. Kersley, yes, the 3% regime remains. However, it's no longer 3%. It's now, is it 7% C or 9%?
9% with the CSR, the CRN.
So it's the climate change levy and the fair share contribution. So it's a bit of a misnomer. People still refer to a 3% regime, but it's actually going to be 7% now, which is quite a big difference. And as we said, a domestic company, which according to the EDB is taxed at 15%, can actually be taxed at 24% now. And even if you're below 25%, 24 million rupees, you'll be taxed at 19% because it's 15% base, 2% CSR, the corporate social responsibility, and 2% of the climate change levy. So yeah, things are, you know, I think the EDB used to talk about Mauritius being a 15% across the board VAT, personal tax, corporate tax regime, and that's clearly no longer the case. Heemshika mentioned that fair share contributions don't apply to a GBL. Yes, we confirm that. So the to answer one of your other question, yes, the corporate tax rate for GBLs remain essentially the same, except for GBLs that avail of the export 3% regime. Does the property tax apply to non-resident companies or only individuals? So we'll have to see how that comes out in the finance bill, but I'm sure there will be legislation to ensure you can't, you know, hold it via a domestic company to get around that. There's already quite a lot of anti-avoidance legislation in Mauritius to preclude a non-citizen from being able to incorporate a company and then buy property that only a Mauritian would be able to buy. So I think we can assume if the ultimate beneficial owner is a non-citizen, then no matter what the interim step is, the intention will be to apply the CGT. Would you agree with that, Sia?
Agree, yes.
Cool. Okay, guys. Well, thank you so much. Any more questions, please email me or Heemshika directly. Otherwise, thank you, Heemshika, for a great presentation, and everyone enjoy the rest of your day further.
Thank you, everyone. Enjoy your day. Bye.
Bye.